Ladies and gentlemen, it's a great pleasure having you here for our fourth quarter advisory board meeting. And it's an even greater pleasure to have a real expert here on the discussion, Alexander Stahel. Alexander, thanks for taking the time.
Thank you for having me, Ronnie. Nice to be here.
Hey, Alexander. Hi. Welcome from Liechtenstein.
Thank you, Mark. Hi.
Mark took the orange pill, attending some Bitcoin conferences recently. We can talk about Bitcoin later on as well, but we will focus on energy markets. And over the last couple of years, we saw that, everybody became a virologist, afterwards a geopolitics expert, and now everybody is an energy expert. But I really prefer talking to real experts, and Alexander is such an expert. He actually became quite a star on Twitter recently, putting out some fabulous threads about energy markets. So Alexander, thanks for taking the time again.
Thank you for having me.
Well, before we get going, let's do some housekeeping. What happened over the last couple of weeks and what's gonna happen in the fourth quarter on our end. Well, first of all, we are very proud that our inflation protection fund just received 5 stars at Morningstar. So that's the best rating, obviously, and we're pretty happy about the performance so far. Actually, one would think that inflation protection is quite easy in this year, but actually most of the classic inflation sensitive assets didn't really perform as expected. So we're very happy about our positive performance and about the 5 stars that we just got from Morningstar. Then Mark and I just attended the Russell Napier seminar in London, financial history course, which was obviously quite interesting if you're sitting in the middle of was like 40 asset managers, primarily from London, in a week where actually the gilt market almost collapsed. So that was really a moment to remember. It was very interesting to see what's going on, how close we were to a complete implosion of not the smallest bond market. Then what happened else? I did attend the 2 large mining shows in Colorado, the Precious Metal Summit, as well as the Denver Gold Show. So I had 74 one-on-one meetings with mining companies. We continue to see lots of value in the sector, but obviously there's some weak spots that we see, especially in the developing space, and I think they are facing some sort of a triple whammy at the moment, with a complete implosion of risk aversion in the gold sector, rising capital costs, and obviously cost inflation when it comes to building a mine. So I think in the junior space, but also for the large caps and the royalty space, there's lots of great companies that we put on our webpage, watch list, and that will add to our portfolio once our inflation signal rises to rising or switches to rising inflation. And then over the next couple of weeks, we'll be very, very busy. We will be on the road quite a lot. Mark is speaking at a big conference in Dubai. He's going to be on a panel with the head of the LBMA, but also the Moscow Gold Exchange. I'll be in Zurich at the Precious Metal Summit, as well as the Edelmetall Messe in Munich. Then there's the Deutsche Goldmesse. Mark is going to be in Prague. You also spoke at a great Bitcoin conference in Innsbruck. So as you can see, we're quite busy these days, and it's absolutely exciting being a market commentator, but primarily an asset manager in times like these. But now I want to formally introduce Alexander Stahel. And first of all, I wanted to ask you, this is a question coming from one of our partners, Stefan Kremet, who is a big FC Zurich supporter. Are you somehow related to Florian Stahel?
No,
Okay. He said he was a great defender, Florian Stahl, playing for FC Zürich. Well, Alexander Stahel, as I've said before, he is very, very active, very vocal on Twitter. That's where we actually met. I really love his threads, his deep dives into the energy sector. He is now the founder and CIO at Burggraben Holding, which is a long-short equity debt value investing boutique, I would say. Before, you worked at Babcock and Brown in London. You were a senior executive partner. Before that, you worked at Mewag AG in Bern. And yeah, your education, you got a Bachelor of Economics at the University of Zurich and an MBA at the prestigious University of St. Gallen. And you're a captain and commander of a tank company in the Swiss Army. So
correct.
That's a very, very impressive CV that you have, Alexander. I won't read all the board experience that you have. So thanks again for taking the time. Well, I think to start off, it would be great if you would introduce us a little bit to your investment style, what Burggraben actually does, and where you focus currently, and then I would say we will focus on particular trends in the commodity space, in the energy space, and then we'll see where the whole discussion will be heading to. The floor is yours, Alexander.
Thanks, Ronnie. Look, I'll tell a couple of angles that people may not know, and I'm sure there are interviews about us out there, and so certain aspects we've never covered. But my father was a cotton trader, and in fact, quite a large one in the 80s. I think the second largest one in the world. And what happened there is two things. First of all, a lot of cotton comes out of the former Soviet Union. And so we always had an angle to look at this specific region, and it was in hindsight helpful for me to learn about these things early. Secondly, of course, you discuss commodities. When you do one, you discuss others too, and that is very helpful because there are certain specifics in commodities that apply to all of them, and that are not the same for equities or debt. You know, I like to say equities and debt, they are anticipatory assets. They look into the future and discount something in the present, whether it's a bond or a piece of real estate or a security that prices whatever it is, from Google to oil, anything. Commodities, they live in the present. So they need to clear the spot price according to demand and supply. And there are specifics for such commodities. And they are very different depending on the type of commodity. And I'm sure we'll get back to that. So oil is not the same as, say, aluminium, where storage is not a problem, but for oil, it sure is. Okay, so that's one angle. Then secondly, believe it or not, I never wanted to go into commodities. I thought it's very boring. By the way, Mark Rich, the oil trader, also here in Zug, that now later created, that moved when he was, call it, the enemy of the state of the United States. He moved to Switzerland, became very close to my dad, and you know, in fact, they became partners. And so later on, when they spun out, or when Glencore took off on its own with Strohtrotte in the lead this time, and with Outmark, you know, also because of age reasons, I always had, I think, quite a good insight into the world of commodities. So that's another angle there that I don't know, many people probably don't know it. And then so anyway, I never wanted to go into commodities as, call it, a commodity trader. I thought it was quite boring from looking at what our people did. I thought I want to do something a bit more challenging. And so I went into investment banking and then tech at the, you call it TMT desk. Mm-hmm. And so I came into this first hype of the dot-com bubble. And everything that happened there was a very helpful lesson, because I thought it was repeating just now again. It had to do with interest rates, but it was also this narrative-driven perception about what companies can do. And you remember, I'm sure you guys remember, back in the days in 99, the Cisco was the thing that everyone thought that can only go up. And then there was obviously Microsoft already, the success story. And it went on and on. And in fact, our bank at the time, SBC Warburg, was part of the Amazon IPO and was part of the Google IPO. So I was indirectly a little bit involved in that, although I wasn't anywhere close to the lead team that helped IPOing it. But I read a lot about it. And you know what? It was never obvious to me, although I did a lot of work in the sector. It was never obvious to me that Amazon would become the winner, or Google, that they were. You remember there was Alta Vista, which was a much more friendly, and what we called at the time directory and so on. So anyway, I touched that sector quite a bit. And in fact, I went on to work for a software company, because here was a gentleman, a very successful entrepreneur in the medical industry, that more or less asked me to join the company, because there was a couple of things to be fixed. And so I was 3 years in a software company called Optree in Basel, running it in various functions, and being, so to speak, the trusted person, not the only one, but certainly an important one. And I started to better understand how difficult that industry is too, and how hard it is really to scale a software company. And I think later on, that helped me to go back into the commodities world, so to speak, with confidence, because, often when you don't know sectors, they look a little bit greener, a little bit shinier from far than they really are. And so this time and that, by the way, was also this 2000 to 2003 experience also was the main reason I started to really read every single book about Buffett. He himself never wrote the book, but I certainly read every book that every person out there wrote about him. And that really, that deeply influenced my style today. So I am really someone, first of all, that takes care of my own money, but also takes care of clients' money. And we try to invest as if we say only invest 20 times in our lives. And we try to really invest in what we call a company, not a piece of stock. And we try to really look at these things as if we own it completely. And that gives us kind of a process where we hopefully try to deeply understand how every element of the company, whether it's the production side or it's the reservoir side, because we have a tendency to focus on commodities, or I would say we are commodity specialists, or whether it's the logistical side of the company and so on and so on. But also the political side, because obviously I'd love to invest in commodities in Switzerland, but we don't have any. Or in Austria, but you don't have any. And or in Germany, right? They have very few there. So we have to go to places where you and I, Ronnie or Mark, we didn't go up, right? But we somehow have to have a perception about how they function and what it really is. And also from that angle, I think my family background again was helpful, because obviously we discussed these issues, and I would say there are regions today where, yes, I went to, and I wanted to understand a lot, but I concluded that it's just unhealthy to invest. And then there are other regions, however, which I think are in the perception of the minds of people that do it casually, not like the three of us. I think they are perceived as too risky when they are actually not that risky. They may be corrupt in places. They may be more volatile in their political landscape, although I'm not quite sure about that anymore because Europe is also very volatile these days. But so that's a thing or two about us.
Alexander, having a look at your Twitter feed, I can tell you that you're, let's say, somewhat critical when it comes to European politicians and especially energy policy, especially, Germany regarding, the nuclear power plants and their strategy, if they have a strategy. You're very critical when it comes to the stability of the grid. And you're also very, very vocal when it comes to ESG. You said that the cure to the disease is killing the patient, and very, very interesting things that you bring up, and that you're that actually I think many investors out there don't really dare to mention and to even start discussing. Now, I would like to start, Alexander, with the Europe and the European energy infrastructure. I don't know if you saw this opening speech by High Representative Joseph Borrell. Did you see that one? I thought it was really fascinating because he actually really addressed some of the concerns that we probably already have for quite a while. So he was speaking at the EU ambassadors annual conference, and Borrell said, well, it's a world of radical uncertainty. The speed and scope of change is exceptionally. We have to accept it and to adapt to it, prioritizing flexibility and resilience. And then he goes on and says, let me try to summarize what is happening to us. Maybe I'm wrong, but I want to discuss with you about it. I think that we Europeans are facing a situation in which we suffer the consequences of a process that has been lasting for years, in which we have decoupled the sources of our prosperity from the sources of our security. And obviously, he mentions the dependence on cheap energy, primarily coming from Russia, but also the dependence on cheap labor and cheap products coming from China. So I thought that was really a fascinating speech, very, very open. You usually don't expect something like that from a EU representative. So, Alexander, in a nutshell, what's your view? What's your analysis of the status quo and the near future of the European energy markets?
That's a big question.
That's a big question, I know.
Okay, so when we talk energy, I would say let's divide it into oil, because that is going to be slightly different than European gas. And then we have European electricity. And for a change, I start at the last one. Electricity. And you see, I tried to be short there. We have structural issues in our electricity grid. And when I say ours, it is ours because it's a interconnected grid that is synchronous for all the European continent households. So it goes literally from Morocco to Turkey, and it goes from Sicily up to Denmark. The Scandinavians have a different grid, and the UK, Ireland have a different grid, meaning separately synchronized. And then, however, they are all talking to each other, exchanging electricity. And so, what's the thing there about? We have over, I would say, 10 years now systematically underinvested in the grid. And when I say underinvested, the grid is about three things. It's about the production assets that produce the electricity, and they can come in different profiles. It's about the location of the assets, because we cannot just transport electricity without having transmission lines, and certainly not for any distance. And then thirdly, it's and that's probably the most important of them all, it's about timing. So our grid functions on a minute-by-minute basis. The load and the consumption and the production of electricity, so the load meaning the consumption of it, have to match. And that we measure with frequency of 50 hertz, and that frequency has to be in a very tight, narrow window. If it gets out of that, infrastructure gets damaged, meaning a transmission line can overheat and break, and rather quickly. And so operators be aware only when they have to keep the frequency in sync, they have seconds to do so. That's why they have a very careful planning process. 40 operators are around in Europe where they constantly talk to each other. They make call it a quarter-hour planning, half-an-hour planning, hour planning, and then a day planning, and so on. And the electricity gets bid and asked in order to match the load. Now, we have, however, since 20 years now in Germany, what they call an Energiewende, so a change in energy. And then we have in different parts, different variations of problems. And why is the Energiewende a problem? Isn't that, what we all want and what we all need to do because of climate change? We need to decarbonize, and isn't that a great thing? Well, it is and it isn't, because the German way of doing it more or less says, by the way, the future assets will be wind, solar, and a bit of gas. And then you have some leftovers like biomass and waste, but they don't move the needle. And what you have today, coal, so coal and lignite and then nuclear, you have to get rid of. The problem is the fossil fuel-based electricity as well as nuclear, they are what we call baseload power production assets. So they can deliver the electricity if and when the operators at the grid level need it in order to match the load. And the load, by the way, on a daily variation can change drastically, because when we come home as human beings, tend to use the most electricity between 6 and 10 o'clock at night. And then, of course, during the day, we use a lot of electricity in the industry side. And then at 3 o'clock in the morning, we don't use a lot of electricity. So you have to get the load down again. And so this constant matching process daily, this fluctuation, and then over the year, and then you have seasonality too, because we use more electricity in winter versus the summer. So the seasonality of the grid too needs matching and needs very competent people. And we have them at the grid level. So let's be grateful. But the point there is, you can throw so and so many problems at them, and at some point they will not be able to solve it in time. And again, time means seconds. It doesn't mean like someone can sit there and think about the problem and let me call my boss and what should we do. It means you need to have a reaction immediately in order to match the two. And so what's the problem about the wind and solar? Well, they come in the mood of the weather. And when we have cloudy days or no wind, then they don't come, and then they need to have different solutions. And those are advertised to be a storage in the future, right? And transmission lines that we're going to have. But we make progress on neither. So storage in reality, we can talk more about that, but in general, for your audience, take it from me. Storage is in what I call a prototype stage technology for grid scale. So we are nowhere there. We are, by the way, also in Europe have almost no storage installed. And I'm talking chemical storage that can be released quickly, because there is also mechanical storage, which, by the way, the Austrians, the Swiss, the French, and the Norwegians have a lot of for their water reservoirs, where we can store energy there. But that's mechanical storage, and that releases differently for grid purposes, meaning within days. But when you have to match grid, again, you need storage, chemical storage that can be released in seconds, and at grid scale again. So we are nowhere there, and yet what happens in the political landscape is that nevertheless, the laws, climate laws in place since June 2021 in Europe, for your audience that outside Europe that don't know that, means everyone has to decarbonize. And so we don't invest in the old. And that has two aspects of it. So the old means in either producing hydrocarbon asset, like a coal plant or so, but we also don't invest in the production of the feedstock of those assets. So we underinvest in hydrocarbon production too, whether it's coal or whether it's oil or whether it's gas. So that has ramifications at some point. While some parts of the world still invest in it, we as Europeans, or call it West, invest certainly less, and that is now ongoing for years. Now that could be fine if all of us human beings would consume less of it. I wouldn't mind. If we can get rid of that in a very structured way, and everyone would agree that we don't like hydrocarbons, and because they emit CO2 and that heats up the planet over a long period of time. And I'm not a climate scientist, so I don't want to go into that too much. But the point is, if we would use less, I wouldn't mind. The problem is we all use the same. Now, some people say, no, but you don't understand. I have this new car and it uses actually less diesel than it used to use 10 years ago. But that's not me or him or her saving. That's the industry saving for us. And that's gone too now, because the car industry by now is actually not putting their engineers to work for a more efficient auto engine, but it's actually about producing battery electric vehicles, and that's where the brain sits now, and that's what they develop on. And therefore, there is a big chance that we actually consume more in the future, because the progress on the engine side becomes less and less. And there are exceptions. Toyota takes a different approach for good reasons. But I would say all the other main car manufacturers actually are going in the direction I just explained. And then, so that's the grid. And there I'm just seeing, because of and then the last part of the grid, we have clearly over the last 20 years, we had what I call a green movement led in Germany that is anti-nuclear. And that has, like a cancer, spread into all sorts of pockets in Europe. And having said that, yes, we've seen the exit of nuclear. For instance, in Sweden, we just saw it very clearly. So they committed, the new government that just came in 2 weeks ago now, to actually build out nuclear rather than getting rid of the 6 nukes they have. And we have a new nuke in Finland and so on. But we also have problems.
But sorry, didn't it take them like 15 years to build it in Finland?
Yes, Ronnie.
What I just wanted to say is, I think even if we have a swing in this direction, that nuclear power is now being accepted, if we take the decision now, let's build more nukes, there's a huge time lag involved, yeah. And I think Cameco was very smart in hindsight, yeah, to make that move with Westinghouse. So what would you say on average? How long is it gonna take to build? If I make the decision now, how long is it gonna take to start producing energy at a new nuke?
I tell you exactly. So in the past, we used to do them at between 6 and 9 years. We produced them from permitting to finishing, everything, schnick schnack, fix, fertig. And we did not 1 or 2, hundreds. Mm-hmm. All over Europe, all over the US, and between the 1950s and 1990s, when we were still, or 80s, end of 80s. And then, since then, in Deutsch, der Wurm ist drin, since then we are not getting it off the ground anymore. We lost confidence about the technology. It's considered high-risk technology, which I completely disagree with. And so that led to different elements, which are, for one, permitting takes longer and longer, which you diverted to. And then 2, we have an absence of talent, or call it the industrial scale companies that are ready to do so. Right? We used to have, different countries with nuclear competence. Certainly in Germany, we had a huge competence cluster, and we've more or less lost that. as one example. And so, yes, Ronnie, it took actually the Finns 17 years, not 15. And then we have 2 nukes in Slovakia, which Enel was trying to build, and one is now complete, reactor 3, and reactor 4 is still not quite finished, but almost. And that took 18 and 19 years so far. And those are state-of-the-art nukes, generation 3. They will be just fine, but yet there is resistance. So Enel, imagine Enel, not some small company, despite having the support from the European Union, lost financing twice because of nuclear lobbying. By the way, also in Austria, they had a financing package which they lost. Erste was one that said, no, we don't want to have anything to do with it anymore. First they said yes, then they said no. And so there is a lot of brinkmanship going on behind the scenes when it comes to new nuclear, and therefore you are right, and we call that problem the H-bomb. What is the H-bomb? Well, we're going to lose from an H perspective. When we just look at the European nuclear reactors, we're going to lose 20 gigawatts installed by 2030, realistically. You know, they usually have a lifeline of 40 years. They are most often extended to 50, and many of them can do 60. And that doesn't mean it's the original nuke that was there, right? They are constantly upgraded and improved, and like so many other things in life, right? And yet, if we just stick to the age that they have, we need to replace 20 gigawatt installed. And there are almost no projects. There is another one in France at the moment, a project 1. And there is one in the UK, and that's the end of the story. So we have now your audience may say, what's the problem? Let's replace them with wind and solar. And well, I just explained that's not baseload power. B, we don't have storage. And C, if you want to do that, replacing 20 gigawatts would need something like 3,400 windmills. And for your audience, I've installed and invested in wind. So I know a thing or two about it. So I read a lot of rubbish out there, and we've done it. And I'm not talking 3,400, the ones that we currently use. I'm talking a 15 megawatt turbine we would need. And we have one installed in the Netherlands offshore so far. And so what I'm saying there is that these, the energy density of nuclear is de facto not possible to replace. And I don't like when politicians, by now take over, call it the green language, or even media, ARD, ZDF, all these European very serious media platforms take over the language of the Green Party in Germany, where they talk about high risk technology. Well, if it's so high risk, why don't we build the new generation 4? Where, in German, schnelle Brüter, which is, these fast burners that actually use, instead of the accumulated uranium, they use the waste that comes out and burn it like a candle. Bill Gates has a long video on YouTube about it, explaining it, because he invests in that technology. Well, why don't we just make sure that we only have the latest generation, because they're obviously safer than the second or third generation, right? And so if that's really the concern, and there I think comes in this political misunderstanding where everyone thinks we have options. In my opinion, from doing numbers, and we modeled out more or less the entire European grid to the penny, we know all the numbers and we have them live every day in terms of performance. And I have to tell to your audience that it's not going to be possible to have that kind of Energiewende the Germans are trying to do. And if the other European countries try to go in that direction, the result will be a less stable grid, probably rolling blackouts, as we see in California, Western Australia. And 3, we're going to have high energy prices. And that's going to lead to a deindustrialization of many places, certainly in Germany. And in Germany, it's potentially already too late to fix it, but certainly in other countries, we can still fix it. And I think it's extremely irresponsible to just look in one direction and say, I'm worried about what is in 30 years. when we're actually at the moment causing significant and very serious pain today and tomorrow and for the next 5 years. I find that irresponsible, and I don't like the fact that politicians don't open up the kimono for technology and get the engineers, the engineers out and say, look, this is not for us to decide who wins here. It's for the engineers and the leaders of utility companies to get the cheapest, best solution in place, and they can say, look, over 40, 50, 60 years, we want such and such carbon targets. That's fine for me. But at the same time, it has to be a fight for the best technology out there. And if we can have coal plants that know how to carbon capture in the cheapest possible way, who are we to say no?
Absolutely.
So I don't like ideology.
Yeah.
I like the market to fight with each other for the best solutions. And I have nothing against wind. I installed a lot of it, as I just explained. Some of it is very, very good. If you go up to Finland, if you go up the higher north you go and offshore, you have to be offshore, you get productivity as high as 38%. That's very good. You know, a gas-fired plant has a productivity of, when I say a capacity factor of 42%, a windmill can do 38%. Accompanied with the right storage, which we yet to have to find, and the right transmission lines, which should all be included in the cost, you know, those things are fine. But to have solar in Austria, Switzerland, or God forbid, or in Germany, it's just a waste of our resources. It's a 9% capacity factor, if even that.
Well, Alexander,
let solar be in Spain. Fine.
This is great. This is fascinating, and there are so many different angles now to that. But just now, you mentioned something which I wanted to ask also. I'm definitely not an expert in this topic, but that's why we've got you here. So in the general discussion, so first of all, you painted the picture and pointed out the base load problem or fact, I think, which it is. We need base load. In the general discussion, then the point comes storage. We need the storage solution in order to potentially enable the renewables to get a more significant role. And so you just mentioned we haven't found the solution yet. How certain are you? I think because this is often kind of a little bit the hope point which is put out. Well, we will kind of find the storage solution sooner than later, but we haven't. Could you shine some light on this problem? Yeah.
I don't know, Mark, and I think you are asking the question also because you are an expert in what I call the mining sectors. And you know a thing or two about that. And we too. And we look at lithium. And I couldn't tell you how Europe, let me go extremer. I couldn't tell you how we provide 15. So let me start different. The Energiewende, if done as advertised, and by advertising, I don't mean someone talks, I mean the law. If they want to do by 2035, get rid of the coal and get rid of everything, what we explained, the nukes, they get rid of next year already, now 3 months late, but still, and do what they say. They need, for what is called in German, Dunkelflauten, periods of little light and very little wind. They need storage in order to accommodate the minute-by-minute situation of the grid. And we calculated that because we can measure Dunkelflauten. And to me, it looks that they, and of course, you know, there has to be a best and worst case kind of scenario. And in that scenario, it looks to me as if they need between 15 and 25 terawatt hours of storage, chemical storage, not pumped, not mechanical. Now, that is more than the output of the gigafactory once it's done. 1 year production. Now, do we have the lithium, we should ask, is to build a full once full scaled up factory in gigafactory in Nevada in order to even build all the the batteries that they want to build. And I'm talking 1 year only. And the answer is, for the moment, we wouldn't. It would be a multiple of all the lithium we currently used in the world globally. And we are nearly addressing a German Dunkelflaute situation for the Energiewende. We are not talking now the European scale ambition for climate change. And we're certainly not talking about that of the West or China and everyone else included. So the answer, of course, Mark, to your question is that we will never get there, regardless of technology, because storage, by definition, is never going to find the minerals and metals it needs, as far as we know, the Earth's crust has available at the moment in order to do what is advertised. And now, certainly not in terms of reserves. Now, some people may say, don't you worry about lithium, we have enough out there, and we probably do. But there people need to know what mining means. No one wants a new mine in the backyard. Nobody. And if we as a team combine and we convince the Lundin family to join us here in Geneva, the probably best miners other than Friedland, and perhaps I forgot someone, but just the best. And money doesn't matter for all of us. It does, but we would pretend for a moment it doesn't. If we then would go about this, I think, Ronnie, you would agree with me, Mark, we need at least 15 years, and we are sensational then. Friedland just did it in the DRC, and he did it with the best, and money didn't matter, and he got the Chinese on board in order to get that mine up and running, and they produce since this year, and they will be fine. It's a copper mine in this case, but that took, he would probably say 20, if you ask him, because he would say, when I sent the engineers out first in order to find the copper and so on and so forth. So I think people also there have an absence of knowledge about this industry and what it takes and where these deposits are. There are two wonderful deposits in Russia that I wanted to go and see. One is called Udokan in the middle of nowhere in Siberia. Well, that's an orphan now. There is no money for it. No one wants to invest in it. Technology access is gone. Well, here was one of the most important deposits for copper, the replacement. I'm not talking copper growth. I'm talking replacing the aging mines. And it's gone now too. So, this is a complicated world and everyone has rather silly expectations about it.
Alexander, what I wanted to talk about is a topic. I thought it was, first of all, it was really fascinating what the CEO of Toyota said. And I mean, I think they introduced the Prius in 1996, which was, it's a phenomenal hybrid car. I mean, it's not beautiful, but it's very, very efficient. And people always wondered why Toyota, being very, very early on with the technology, why they never switched to 100% EVs, like the German automotive producers actually do now. And the CEO, he gave a lot of interviews recently. He basically said, well, because we know that the raw materials, that the commodities that we would need for that move, they're simply not there. And I posted on LinkedIn a couple of studies, one from the University of Leuven in Belgium, I think, which was really fascinating. And it clearly showed, well, it's simply not enough stuff out there when it comes to lithium, when it comes to nickel, a commodity that I'm particularly excited about. But even when it comes to copper and cobalt, you name it. So I think that was really a fascinating a move by Toyota. However, I think one thing that we tend to forget, talking about the scarcity and the bottlenecks in commodities, and there was this kind of Club of Rome direction that we live in a finite world. I think people tend to forget the technological progress. And I think if we want to take something positive out of the whole situation, the whole mess that we are in at the moment, it's probably that people realized we actually need the stuff. We need this stuff, called commodities for our cell phones. We need it for, to heat our homes. We need it for our lifestyle. So I think, on a positive note, I would say, the public kind of realized that commodities necessarily aren't something bad. Now, another good thing, obviously, is that there's now lots of resources, lots of financial resources, but also human resources working on solutions. So would you say, well, actually, this whole scarcity and this whole crisis that we face at the moment, couldn't it also lead to a huge leap in technological progress when it comes to energy, when it comes to, I don't know, becoming much more efficient when it comes to production, but also to storage? What's your take on that?
Well, first of all, I have great confidence in our ability to innovate, but for that, please allow the human species to innovate rather than constantly stop them from innovating, which is what we are doing right now in politics. That was, I think, my point earlier. Two, I don't think we're in a crisis from a nature perspective. I think we are in a crisis of our own making by reducing optionality. Mm-hmm. And then you get to that crisis. Right. So 2. Then 3. Yes, you see small examples. Cobalt, for sure, they're going to out-engineer of this battery. Cobalt helps to control temperatures in lithium batteries. And I think they find ways, although I just met the former copper head trader or second guy in Glencore the other day. We had lunch together. And he's not so confident that how easy that will be for them in reality, but we'll see. So I think they're working on that. But at the end of the day, you still need the metals, and I guarantee you that when it comes to it's, does everyone agree we like wind? I think almost everyone I know agrees wind. Yeah, why not? Let's get it done. And I'm skeptical about certain aspects of it, but positive in terms of having it in the mix. Mm-hmm. Having said that, our experience in installing wind was extremely painful. I couldn't have been more painful. It's exactly the same NIMBY, not in my backyard syndrome that we see for nuclear. No one wants a new wind farm in the backyard. First of all, there is in German Schattenwurf. So the shed that comes out of a wind farm is enormous and disturbing for everyone that lives nearby. And 2, there is quite a bit of noise, although people think it doesn't make noise, it does. It's noisy. And then 3, you need the grid access and so forth. Offshore, it gets trickier and trickier. Although there we have to go offshore. So, Ronnie, I think I'm an optimist when it comes to human species, but I'm not a very within the democratic cycles of usually 4 to 5 years, our behavior can be quite messy. And at some point, I hope the right politicians come in, and then hopefully we make a jump or a leap forward, but we're not there yet. That's all I can say.
Okay. Mark, do you want to jump in?
Yeah, I even heard it's influencing the microclimate, right? If you have excessive wind parks, I think the temperature increases slightly, which can already have effects on agriculture. But all kind of problems associated with wind and renewable. I'm sure that's pretty clear by now.
Mark, by the way, you're also gonna lose 20% of the wind power you have. So when you have your first wind turbine here and your last one here, and we all want to build farms, not one turbine, right? There, between here and there, you lose 20% wind. Therefore, this is going to be, say, offshore a 35% efficiency factor, and here you're going to have 20% at least less.
Yeah.
Yes, the microclimate is influenced. That's a correct statement.
Right. Yeah. So all kind of problems. But now zooming out again, perhaps like into the broader energy mix. I mean, when we go back to so obviously we need some kind of fossil fuel for the time being. I think there's no way around that, and I think that's also part of your focus where you invest. So when we go on a sectoral view, we discussed a little bit the metals, obviously hugely structural bullishness for this battery metals. I think I don't know if you have some thoughts, which would you give us some kind of a ranking in terms of metals? That would be perhaps interesting. Would you go so far? Which one you really like most?
All of the ones we mentioned. I don't like a metal not. Iron ore. I don't like iron ore. That's sorry. That's a very clear no-go because it's subject to the Chinese property cycle, which obviously is collapsing. So you want to be careful with met coal, and you want to be careful, which is obviously used for steel making, and you want to be careful with the whatever goes mostly into China as raw material in order to provide metal to the property sector, and that's done, finished, 4 years. That's not going to come back. But all the other metals I like a lot. I probably will put on top lithium for now, although we're gonna have at some point potentially a phase of oversupply, and you know how sensitive commodities trade on the margin when this moment will occur. Will come to occur, but then I like copper a lot because it's the conductor of everything, and it's needed in all the applications out there, not just in the battery. So we need it for the electrification of everything in every application. So copper is nice, and it's very hard to replace, although people argue we can replace it with aluminium. If you go here to ABB and talk to them about it, they are not, they say, yeah, sure, and this and that and so on. But, you know, when they have projects that cost gazillions and that are supposed to work for 45 years, they all don't want to experiment. Because obviously aluminium reacts rather differently when it's in contact with water, and so you go through it and so on. So the transmission lines are aluminium because they are obviously much lighter, but they conduct 6 times less well, or 60% less well than copper. And so the compromise there is fine because of weight and the conductivity qualities, but we don't need more there, and they are call it in a static, safe environment. But when it comes to underground, and at the moment we need to build a lot of subsea transmission lines to communicate with each other between the European parts, there you know they use copper, and so I could go on. So copper I like a lot. I like nickel, of course, and then you almost want to go there into more detail. Why? Because obviously I think that what we see at the moment with Russia, call it dislinking from the Western world, there you want to pay attention what's most affected there and how we're going to solve that. And so that's going to be in a, call it structural bull. But when it comes to call it my commodity pyramid, the Maslow, call it the Stahel pyramid, the most important I think is electricity for us, all of us, because it's about life or death. And then the second best I like is gas always, because gas is used not just for heating, but for feedstock, and therefore it goes back into the fertilizer and it's about food. And then thirdly, it's clearly the transportation of everything, which is oil at the moment, and that's going to be very hard to replace for a very long time to come. And people think too much about their own little microscope and our own privileges that we worked very hard. So our predecessors in Austria and in Switzerland and in Germany, and they made this fantastically functioning democracy here. But forget all that, right? The growth comes from a rising middle class in Asia, which has a long way to go. And the growth comes from pure population growth, which is forecast to go from 8 to 12 or something billion. And if that's true, they all want to participate a little bit in the commodities because they all want something from, meaning transport or heat or communication or something, and that's where you need them, and so therefore I have a very hard time when the EIA goes out and says we need less oil in 2050, because this is actually what the climate laws are saying, when actually in reality it's going to be completely different.
There was a great speech by Amin Nasser, the head of Saudi Aramco, recently. Obviously, he's a little bit biased, but I really enjoyed reading his summary, actually about the supply issues and the capex issues that the industry is facing now. But let's talk about let's say the bottom of the Stahel pyramid. I really like that term.
Oslo pyramid.
Yeah. Let's talk about net gas, but also about oil. Perhaps, Alexander, you could shine some light on that topic. As we're seeing, for example, for the United States, we are currently seeing that U.S. drilling activity seems to slow big time. So the number of drilled but uncompleted wells is at the lowest level since 2013. Would you say that, first of all, the role of the United States as a swing producer is kind of over? How would you say is how are the trading skills of the U.S. administration now being very, very active with the strategic petroleum reserves? Do you think they timed the market well? And then the third thing, and I know that those are all three very large topics. How would you how would you interpret the rumors or the news that recently broke out that Saudi Arabia might be joining the BRICS and basically, completely undermine this very, very important alliance between the US and Saudi Arabia?
Yeah. Okay. You are throwing things at me here. Okay. Let me try and keep it short and crisp. So first of all, US shale, which is called unconventional oil. Why is it unconventional? Because oil is usually either in a sandstone or a stone deposit that actually allows the oil to flow, and that's what we call a conventional field. And then it flows less or more, and it needs a bit of help, less or more. And then we have shale, which is a different kind of stone, which is very tight. And in there is oil, which we know for a long time. And we, by the way, have tons of it in Europe too. And then you need to fracture that stone to make, and then you need to put in some fluids and sand in order to cool it, make the oil flow, and then you need on top, you need help to make it flow. And that was always a very silly idea to have. I never invested in it. Once I understood how it works, I thought that they're never going to make a single cent of money. It's not going to happen, right? It's like a liability. It has a decline rate of 75% in the first year. How can you invest in something that has a decline rate when you have an asset that deteriorates in 75% in the first year? How can you ever make money from that? Forget oil, just think about that. And so I was very skeptical. But what is true is that they have a lot of it. And what is then happened in 2010 to call it 18 is that as the Americans are, they had this amazing advertising campaign about, it's the biggest thing since the plow, right? And you have to be in this. And then there were, I don't know, 250 billion junk bonds put into that, and most investors just lost their shirt. And that period, more or less, came to an end in 17, 18 already. Everyone was critical. Judgment time came because promises now had numbers attached, so history. And then people saw, now this is just half of what they say is not true and is not coming to be true, and therefore it became much more about location, because there is tier 1, tier 2, tier 3 locations there, and so they became more economic about it. And by now, it's more or less I think there was a meeting, what they called a meeting in Boston in 2018, where the big pension funds took them to Jesus and said, guys, which part did you not understand? You're here to make money, not to waste our money. Okay, so end of story, finished. Then came a bit of COVID, which kind of, because in 18 we became quite, or 19 maybe it was, we became quite vocal about it, that the shale growth is over. Yes, there is potential, but it's not this hyper growth that constantly keeps that oil price in a window of 45 to 65, because everything prices at the margin. And we're going to get out of that. And by now we are out of it. No one throws good money after bad into US shale. Yes, they will have a business, and the best ones will have, and they consolidate, and it's much more serious, and it's like an industrial rollout, but that is, you know, accompanied by very critical metrics where they make sure they make money, and sometimes that's more efficient, less efficient, but for now, they are all back in the let's make money business, and we have to pay dividends rather than just in this is a growth story, right? And that's over. And you would agree with me, the higher interest rates go, the more that story is over, for sure. Okay, so that's that. And then your second question was, the Saudis, are they going to abandon the United States partnership? No, not going to happen. They will be partners for a long time to come. The Americans, they can say whatever they want, but it's even more in their strategic interest to keep the waters vis-a-vis Saudi Arabia and Iran clean and working, and the US Navy will not let go there, because the Americans also need to import, although some believe they are energy independent, they are not. So they need to import something like 6 million barrels a year, 6 million barrels per day, and a lot of that comes from the Middle East. Yes, they have exports against it, but there is also, that's because they have a quality mismatch with their refinery system. But leaving that aside, the Americans have an interest to keep that whole system working, and they will, and I think the Saudis have an interest to keep it working with the Americans. Now that every single American president each time makes it, you know, cheap politics when oil prices go higher because he's afraid he's not going to get re-elected in the midterm, right? I mean, that game is now as old as there are American presidents and oil. And it's always going to be the drama. And then usually good men in the background say at some point, guys, now calm down. You know, I mean, we're all in this together here, and we need to make sure this is going in the right direction. Now with Biden, you have a rather dysfunctional administration that doesn't seem to understand it at the moment. But also that's not new. If you go to the Milton Friedman videos, I mean, they were talking exactly the same problems that we talk now. Right, and presidents came out and said, let's tax more, let's do this, all the wrong recipes, everything not to address the supply side problem, but to increase it. And Ronnie and Mark, I think our duty as investors is to best navigate those waters and take advantage of it. Because if we start to moralize it, then we all go nuts. Then you had the third question, which was
the strategic petroleum reserves.
The SPR. That is the new toy of the president, right? So for now, he is under the illusion that the releasing of SPRs has actually gotten prices down. I would argue it was a purely macro coincidence where we went in what Ronnie, we call quad fours. And consecutive 3 in a row, where we went into those, and that's why oil prices came from 120 down to 90, and not so much because he released. Look, if we do correlation, and we do correlations for everything, and we try to be on top of this cycle, then usually the best correlation for American oil price and American inventories you get by including all inventories, so the crude, the standard commercial petroleum crude inventory, the product inventories, so diesel, naphtha, whatever, on top. And then thirdly, also the SPR. And then you get the correlation. And therefore, from that perspective, the SPR using, not using is a wash. It's going from left to right pocket, so it doesn't matter for prices. And that's exactly what we can show. So I think at the moment, WTI is at fair value, level at 92, somewhere around there at the current SPR level. Now, we can sadly not do the same correlation for the entire world, because while we have a lot of data, we don't have enough history to be comfortable to say this is actually going to be the regression that we are seeing. But at some point we can, and then we can make a statement there too.
Alexander, you emailed me and said you're actually, you know, covering roughly 500 companies, and you previously told me that you're actually a big data company, and you really know your companies that you're focusing on very well. So
like our family.
So I think you've got the micro part very well covered. Now let's talk about the macro part, and obviously we are now seeing this huge interplay or let's say challenge between, you know, consumer price inflation and on the other hand an enormous amount of asset price deflation. And we're seeing this enormous strength of the US dollar. We're seeing you know, that actually markets are clearly now starting to get really nervous about a recession. So from my point of view, markets are, if you just have a sober look at it, it's obvious that they're now focusing much more on the recession topic than on the inflation topic. Obviously, we've got lots of political risk in markets. We know what's going on in bond markets and so forth. So actually, I would say, you know, given this this turmoil that we're seeing, I think the GSCI is now down 26% from its highs, which is not so bad. Alexander, what's your kind of macro view? You told me that you enjoy following Hedgeye, for example, and their approach. So how does, in your investment style, this interplay between the macro, the top down, and the micro, the bottom up picture actually work out?
Yeah, so we cover the sectors ourselves, and we barrel count, or we gas molecule count, or atom count, whatever in detail, where we can have real-time data. So we need real-time, otherwise it doesn't even make sense to cover a commodity, because what's the point? If it's all priced at the margin, very little change makes a big difference in price, and you're always late. So, so those that we discussed, and some we cover very carefully. And then we figured out in Q4 2018, where we were very long oil, and suddenly everyone was very short oil, and I was scratching my head and saying, gee, I'm blind on one eye. What is happening here, right? And I said, I need to change. And so I really engaged and looked for the right macro template, and not, you know, these casual reports that come out of banks that try to explain you the rosy world, but a process, an everyday kind of thing. So, because again, in macro too, it's about the rate of change rather than the absolutes. And we found this boutique Hedgeye. I think they should pay you for advertising it. But the point is, I really like what they do. I think it's rather affordable, and it's professional, and it's different. And we adhere to that, and then obviously we start to collect more and more our own data in order to follow that kind of, call it nowcasting, rate of change process for inflation and GDP, and for different parts of the world. And what is happening right now there is that we are in a slowdown both of inflation, and we have to be careful. Let's say the US is in a slowdown of inflation at the moment, although at a light level, and then of course in a slowdown of GDP, and that's what we call a quad four. And in that process, in quad fours usually is when accidents happen in capital markets. And you know, you mentioned before the UK pension fund system, because inflationary pressures push up rates, and that usually in those highly leveraged environments doesn't bode well for how they can navigate this. Now, maybe just a word on inflation there. You know, what we see, or, you know, there was this golden rule that Druckenmiller once explained, is that we never managed to get inflation CPI back down unless we had the Fed target rate above it. Now we're probably going to, and that's the rule for the last 50 years, and that probably we're going to break this time, right? Because we agree, if we take the euro area, I think it's 1.25 ECB target rate, and we have what on average 9.1% CPI for the euro land, as high as 15, and then a bit lower in certain parts. So we're probably not going to get the ECB target rate above 9, and yet I would say one has to be very careful to expect a slowdown in CPI in Euroland because a weakening euro against the dollar, because some structural issues on the commodity side, and then on top we created ourselves an electricity problem. So that's pretty bad. The combination, right, which goes then through everything that we produce. And so on that basis, I have a hard time to see inflation slowing down in Europe. It made us because we create that, we more or less now create a recession in 23. And of course, those have self-healing, call it effects on inflation. But how much of that inflation is really demand side driven and how much is supply side driven? And there was even a study out the ECB that said about 5% is supply side driven, and we'll see how that pans out. The point is, those rates have to go up, and if they and we're just at the beginning, warm up, and people have to think very hard about that, because this, what we had for the last 25 years, 30 years kind of environment, this constant deflation where everyone and the brother were kind of explaining you that money is going to be cheap regardless what central banks do. That period is over. And we are now probably in a, call it 5, maybe 15-year patch where we have scarcity of all sorts of things because we underinvest. We created more bits and bytes instead of molecules. And now the chicken come home to roost, and we will need a lot of time to correct that. And because that's true, everything changes in the investment landscape. Because long duration assets like tech, like real estate, like bonds, they're going to get punished on a higher interest rate environment and over proportionally so, and probably accelerating so. Now, people argue then and go further and say, no, but you don't understand. The Fed, the ECB, they're going to break everything. And they have to stop at some point. And I say, that is a misunderstanding. They are not here for the Wall Street while that was convenient to be there for them in the past. At the moment, their issue is now der normale Bürger auf der Straße, the normal citizen on the street, and they have to go back to their original mandate about controlling inflation. And if they don't, the ECB, then don't be surprised if one moment we all wake up, we read our newspaper on Sunday morning thinking nothing bad, and then we read, oh, the D-Mark is back because the Bundesbank has reintroduced the D-Mark because they are afraid the ECB doesn't manage to control inflation. And we all know the Germans hate inflation since the Weimar Republic. They fear it more than the devil. And so I think there is, people have to take a step back and look at what is happening here and what the causes are for it. And the word is inflation. And the word is commodities. That's why I once tweeted, if you don't do commodities, you will have a hard time to navigate this environment, because I think so much can be understood from that angle this time around, when nothing was able to be understood 10 years ago, now almost everything. And I hope we can benefit for our shareholders on that basis. But yes, it's tough, and it's going to stay tough out there. I think that the rates increase is in the beginning, certainly in Europe, and is also, I think, not done in the United States. And then we'll have to see, because then we go, what the Fed currently is doing is more or less manufacturing a recession to take, let's say, 3% demand side inflation out. And then let's say they meet at 5, the 10-year, or call it the Fed target rate to keep it simple, and the CPI. They meet, say, in, I don't know, Q2 2023 at 5 or at 5.5, something. Let's say that, right? Let's assume so. We're a moment at 8.2. If that's the case, then everyone says, okay, done, fine. So now we're fine. Now what? Then we go back to economic activity. We look forward a little bit. We come out of the GDP contraction. Then we right back in everything that we just described now. Because then we're really again short of everything. So that's why I say the economic cycles are shortening, and we are just going to have more spikes instead of call it those 7 to 9 year outlooks, where what a normal economic cycle would look like. I think we are now into a 3-year cycle.
That's extremely fascinating. I don't know if you had the chance to look at what we wrote in Goldman Trust report this year. It's quite extensive read, but I mean also in our conclusions, that reminds me very much of what we wrote this year. Also the last year's, our scenario was that we're going to have a higher inflation, structurally higher inflation environment, but also we do point out to people that during such a period, inflation rates can definitely drop in the meantime, which shouldn't be confused with that this problem will go away. And that's actually kind of how we also see this short and medium term, rather that inflation rates perhaps will turn down sooner than later, and this could be misinterpreted by the market as basically this problem going away, and the tightening cycle will perhaps be ended way too early to basically get rid of all this inflationary pressures which have been building over so many years. So I think we're very much in the same camp on this greater macro picture.
May I add, Mark? May I add? I will call it. We are in a stagflationary environment for a decade, maybe 2. Who knows? That comes down to policymakers. Not the least because of climate laws. We'll see how we address, and then we can change our mind when people start to do the right things. They don't at the moment. And on that basis, don't mix up what I call the cyclical nature of inflation with the structural nature of inflation. And we are slowing down rate of change, and we go back up, and we slow down and we go back up. And those can go much higher.
Right. Right. And this is actually at the end of the day, I don't know if you have a view on that too. I mean, obviously central bankers and the banking industry is not completely monolithic. There are obviously very many viewpoints within this kind of community too. But I think one of the considerations, especially from the central banking side, which they obviously hardly ever would admit, is some kind of reflation or inflating away the huge amounts of debts. They're clearly conscious of this this problem. I'm sure. So that also would be perhaps not even officially, as I said, but it also perhaps would be a scenario which they, from that point of view, are quite sympathetic. Yeah, they are quite sympathetic to that, because isn't that kind of the best case outcome even for the system to some extent?
Look, the problem is, and that's why I think it, as Milton once said, every inflationary phenomenon is strictly monetary, and then he said a lot more about it. And then there are some counter theories about it. But anyway, I think we also deglobalize versus we globalize. So we have mega trends changing at the moment. But one thing, maybe one element that helps your audience, we are, we went, this monetary phenomena leads or is already starting to mean that the Federal Reserve and the ECB are monetizing the government debt. And that usually is the sign when even the MMT guys ring the alarm bell and say, we like MMT and we explain you why we believe we can do it. But now that you, Fed, monetize our government bonds, that you're the last resort buying it, that's not good. That leads to inflation. So, I mean, if you read Stephanie Kelton's book, that is in there too, to be fair, right? For the MMT guys. So we're not on a good path.
Right. Alexander, we're slowly coming to an end of a fascinating discussion. What I wanted to ask you is, because I mean, we are pretty active in the commodity space as well, and I think like 1 year ago, for example, if you talk to an institutional player about commodities, actually, you probably weren't even invited. You couldn't pass, like, you know, the secretary at the in the office. So now it really seems that there is some sort of shift slowly happening, and I mentioned the uranium space, for example. As you know, we do manage one uranium fund. We're seeing in general that people are a little bit more concerned and following energy markets in general. What would you say, being a very active investor, when it comes to commodities? So far, they basically don't have any allocation in commodities whatsoever, due to ESG. I think, you know, from a legal point of view, many of them actually had to shun and sell everything that is related to fossil fuels. We know that, I think, Munich Re, they said, well, actually, for example, we won't make any insurances for new projects in the fossil fuel space anymore. So do you see some sort of a renaissance slowly happening when it comes to institutional players, or will it even take more time?
I think it takes more pain. I don't see resource allocation. I don't see change. If anything, we have to be grateful if it doesn't get worse. Because I think the Americans are, you know, we Europeans already are acting along the lines you just described, but the Americans not necessarily, but they are going now in that same direction. Mm-hmm. And I think it needs more pain. I think $90 oil is no pain. You know, this oil molecule is such a powerful thing for the human species. And people just lost any respect for it. And I think at some point commodities will have to go in an anger phase where it's 200 and then everyone starts to respect it.
Yeah, I mean, on an inflation adjusted basis, oil is dirt cheap, obviously. Mark, is there anything else that you want to ask Alexander?
We could go on for hours. It really is fascinating. Perhaps just very shortly, one question still on the US dollar. I mean, generally we know structurally commodities are negatively correlated to the US dollar. That's like the super top-down perspective, if you will. So do you at all consider the dollar? Because I mean, it's also something which is not very predictable so easily, but currently it looks very strong, also due to the structural differences of the economies, which we already partly touched. But I mean, commodities this year have proven to be able to also rise in a strong dollar environment. So do you look at it at all, and do you have any opinion?
Oh yes, it's a very important data point for what we do. So we went bearish metals mainly because of China and the dollar in May, publicly so on Twitter, and we went bearish, and people didn't like me going bearish, but I'm bearish oil since July, not like mega bearish, but carefully so, educatedly so, and the main reason is the dollar, which what I call the US dollar wrecking ball. And then people from a US perspective tend to have a hard time. I'm not talking the pros of the pros. I'm talking the average person. You know, they say, well, what are you talking about? Everything's fine, right? But the dollar is just in Asia at the moment is doing a lot of damage. For instance, if we look at Russian export, the Far East is almost is not under sanction, can do gets Russian oil at the $22 discount, and yet they almost not buying Russian oil at the moment. It's just the dollar is hurting their purchasing power a lot, and this is a warm up. again, I think 2023, what is it about the dollar, right? It's our dollar-euro problem. Everyone needs it. Everyone needs to refinance it. I don't know, 77% of all transactions are in dollar in the world. And so everyone is then kind of in those recessionary times short the dollar, and now they need to buy it even more. And that process needs to run out. And then I think we can calm down again. And that's when you have those spikes that I'm describing, because then demand comes immediately back in commodities. But what we are seeing at the moment is hurting demand. So from that perspective, it's not the wrong measure to look at in commodities, but there is no good correlation over 30 years on it, because it really comes down to the threshold it reaches. And that can change depending on the environment. So just because, and don't look at the Dixie, because dollar, right, we have to compare to something. You want to look at so dollar versus emerging market currencies. That's where the sensitivity is on demand. The DXY, which measures mainly the euro and the dollar and a bit of yen and a bit of pound, is completely irrelevant. That doesn't tell you anything about demand of oil. So that on the side, people talk about the useless measure.
I think, yeah, that's a very good point that you bring up, Alexander. I think we're seeing extreme strength of the US dollar, or rather weakness of the pound and the Japanese yen and the euro versus the dollar. But for example, measured against the Brazilian real, actually it's fairly stable. It kind of goes sideways.
Which is why Brazil is booming as the only exception of all the emerging markets.
So I could envision, strength of the dollar versus the the very dirty shirts when it comes to currencies, being the yen, the euro, and perhaps also the pound. Although there will be a bounce happening from a technical point of view, but also weakness of the US dollar measured in commodities terms. I think that could be a scenario playing out. And by the way, Liz Truss, she stepped down just now. I saw that.
Okay.
Well, there was this meme on Twitter showing a lettuce and then Liz Truss, and it said, "Can this lettuce will it outlast Liz Truss?" So actually the lettuce won, and yeah, I mean that's another confirmation how volatile everything is at the moment.
As you talk about it here.
Yeah. So Alexander, we're coming to an end. First of all, thank you very, very much for your time. We really enjoyed that. We hope that we can meet in person soon. I would like to quote Charlie Munger, who is on your webpage, saying, "The whole secret of investment is to find places where it's safe and wise to non-diversify." Yeah. It's just that simple. Diversification is for the know-nothing investor. It's not for the professional. And I think over these 1.5 hours, we clearly saw that you're a true professional. So thank you very, very much for your time. We greatly enjoyed this. And yeah, let's meet again soon.
Let's stay in touch, guys. It was a pleasure to be here. And thank you very much. It's an honor, and I admire your platform you created. So my congratulations to you, Mark, and to you, Ronnie.
Thank you very much, Alexander.
Appreciate that. Thanks.
All the best. Thank you very much.
Thank you very much, guys.
Take care.
Bye, Mark.
Cheers. Bye-bye.